Hello, good afternoon, everyone. My name is Udoka Anyao, and I'm presenting our project on the Lloyds Bank greenwashing matters with Elvis and Fahana. We've been commissioned by the Lloyds Bank to deliver a strategic advisory report on the ESG performance and green credentials. As Dempe in 2024 explains, financial greenwashing widens the gap between ESG marketing and measurable climate action. Galata in 2024 adds that this credibility gap is especially problematic for banks where investors must trust and where the investor trust and global climate goals are at stake, Between 2020 and 2024, the UK's big four banks are financed around 119 billion pounds in fossil fuel projects, with Lloyd's fossil to green lending ratio at 3 to 1. According to the Influencing Map project, with Lloyd's fossil, uh, the further reports showed that global fossil fuel funding surged to 869 billion in 2024, undermining the Paris Agreement. At the same time, uh, Lloyds promotes a 2050 net zero ambition while underwriting oil majors, as highlighted by Lloyds Banking Group in 2023. These misleading claims, as noted by the CMA in 2021 and the FCA in 2021, weaken the green claim codes, and erode global trust. Moving to slide 3 now. We are trying to understand the stakeholder landscape is essential for assessing Lloyd's ESG position. Freeman states that stakeholder theory requires banks to balance the interests of all groups, not just shareholders. For Lloyd's, these stakeholders include customers, investors, employees, regulators, NGOs, government, and wider society. PwC in 2022 notes that the customers often pay a premium for ethical products, but risks being misled by overstating green claims. Investors, particularly pension funds, demand reduced fossil exposure and transparent ESG reporting as share action, as 2024 highlights. Employees value purpose-driven and climate-positive workplaces, as reported in Lloyd's 2024 Sustainability Report. Regulators like the FCA, the CMA, and the ASC are enforcing anti-greenwashing rules to ensure claims are verifiable, such as Influence Map in 2025 challenge Lloyd's ESG narrative. While government policies like the UK Green Finance Strategy place bank at the heart of the net zero effort. Going to slide 4, we will be looking at the key theory framework. To assess Lloyd's green claims, we rely on stakeholder theory and the triple bottom line. Our Etim and Ogbonda in 2024 highlight that firms must consider the interests of all affected groups. Freeman in 2010 warns that neglecting stakeholders undermines long-term trust, especially in finance. In this study, we test Lloyd's claims against customer, investor, and regulatory experience. The triple bottom line, developed by Al Kintin, emphasizes the balance of profit, people, and planet. Nogueira, Gomez, and Lopez 2025 show that companies excelling in all three areas attract sustainability capital, while Gunawan Pemastasari and Sharma stressed that environmental transparency strengthens legitimacy. We also apply these frameworks to compare Lloyd's ESG marketing with fossil fuel financing, environmental disclosures, and stakeholders' responses. This reveals the disconnects that guide our policy and recommendation. Now, slide 5, moving to our research methodology and the data sources that we used for this assignment. We used a mixed method approach to examine the gap between Lloyd's ESG marketing and its actual performance. On the qualitative side, we conducted a content analysis of 5 key disclosures in Lloyd's 2023 sustainability report, including helping Britain prosper, the net zero claims, the green mortgages, the ESG partnerships, and carbon offsetting initiatives. Khan in 2020 confirms that the content analysis is effective for identifying inconsistencies between claims and actions. On the quantitative side, we relied on the fossil financial data from Bloomberg 2023 and Banking on Climate in 2024 to measure Lloyd's exposure to carbon-intensive industries. Our analysis followed the GRI Universal Standards in 2021 and the IFRS in 2023, both of which stress transparency and comparability. As Freja and Kinsey in 2021 notes, triangulation with third-party data enhances reliability and provides a holistic view. Although we recognize limitations, such as reliance on secondary data and challenges in assessing Scope 3 emissions, triangulation and independent verification strengthens our findings. So let's look at the content analysis and triangulation. Slide 6. We evaluated 5 flagship disclosures: helping Britain prosper, green mortgages, ESG-linked partnerships, carbon offsetting projects, and net zero targets. Using the GRI Universal Standards 2021, we assessed these claims for clarity, specificity, and evidence. We tracked all these with key terms such as net zero, green finance, and carbon neutral to identify patterns. Our analysis compared with third-party data revealed a clear credibility gap. According to the Bank on Climate Chaos in 2024, Lloyd financed around $8.5 billion in fossil fuel projects from 2026 to 2023, including LNG terminal and oil pipelines. This is very alarming. Bloomberg in 2023 reports that despite the $1.1 trillion in global energy transition investment, the fossil financing remains significant. Scholars such as Khan warn that selective reporting like this risks reputational greenwashing. By triangulating Lloyd's, this narrative with financial data and global benchmarks, we built a robust and evidence-based assessment of its sustainability narrative. Thank you. I will now hand over to my colleague Farhana to disclose the Lloyd's greenwashing disclosure in more detail. Thank you.
I am Farhana Ferdos. Now I am describing slide 7. Let's examine Alerts Bank's green disclosures. The bank highlights its helping Britain prosper statement, its net zero ambition by 2050, its green mortgage products, partnerships with Habitat for Humanity and RAP, and various carbon offsetting initiatives as Alerts Banking Group 2023 states. However, Gunawan, Parmatasari, and Sharma argue that alerts well publicized 8.6 billion pounds. Sustainable finance figure lacks sufficient background to ensure transparency. The helping Britain prosper strategy appears more theoretical than operational, as it does not include measurable metrics. The bank's ESG linked partnerships are also presented without evidence of outcomes. Liu and Wu, 2023, describe such gaps as strategic ambiguity, where communication prioritizes uh, image over accountability, under tightening FCA anti-greenwashing rules, or unverified claims may lead to regulatory scrutiny. Furthermore, others misalignment with frameworks such as TCFT and SFDR undermines investor trust and weakness its leadership narrative. Slide 8. Ellers Bank's ESG ratings reveal a clear contradiction. Although it financed over 8.5 billion in fossil fuel projects between 2016 and 23, as banking on climate chaos 2024 highlights, the bank still holds an AA rating with MSCI, a score of 60 out of 100 with S&P, and a lower risk score of 19.7 with Sustainalytics. Um, Barge, Colbell, and Rigobon explained that ESG rating correlations range from 38 to 71% due to inconsistent methods, enabling companies to focus on improving reports rather than real performance. The EU's 2023 ESG ratings regulation aims to standardize criteria and restore investor confidence for alert management. Future credibility which depend on measurable sustainability performance rather than inflated ratings. Slide 9. Alerts Bank is now facing heightened stakeholder backlash. The Advertising Standard Authority banned their alerts advert in 2024, omitting 32.8 million tons of CO2 emissions linked to fossil fuel financing as a marker of reports. NGOs such as Greenpeace and ad-free societies have criticized alerts backing of the Rosebank oil field. Academic research by Mandas 2024 shows that misleading ESG disclosures increase both reputational and financial risk. Global investors now align with SFDR and TCFT frameworks and demand tighter accountability. And slide 10, we model it to potential futures for Alerts Bank. The fast business, as usual, assumes ongoing fossil financing. The Bank of England wants that this approach weakness resilience and increase asset devaluation risk. Nguyen shows that non-performing loans in the United States rise by 0.01 to 0.016 percentage points per 1 degree Fahrenheit anomaly, while NI finds a 0.37 percentage point increase in system-wide NPLs following disaster. Green Central Banking notes that disorderly climate transitions could lead to 4 times higher financial losses compared to coordinated 1.5 degrees Celsius pathways. The second scenario, a green transition aligned with 1.5 degrees C goals and reduces losses as Albany's 2024 confirms. TCFD and IFRS S2 both call for 10 to 30-year scenario analysis to strengthen governance and lending criteria. Elders must embed NGFS and IFRS S2 models into risk pricing, capital allocation, and CETI protections to maintain investor confidence. Slide 11. The UK's ESG regulations leave significant gaps. The CMA and FCA 2024 highlight that greenwashing rules are underdeveloped, while the FCA's anti-greenwashing rule, introduced in May 2024, is in place. Jones 2024 notes that supervisory practice is still evolving. The UK green taxonomy has been shelved, meaning green finance remains largely self-defined, as Barwi 2024 explains. Thank you. Now turn to Albis.
Hello there. Right, so moving on to slide 12, I will be looking at the comparative policies with the EU, the US, and the global models. Now, to understand Lloyd's position, we compare global ESG policies. The EU's Sustainable Finance Disclosure Regulation, the SFDR, is regarded as the gold standard, mandating detailed ESG risk disclosures and verify principal adverse impact metrics, as noted by the European Commission in 2023. By contrast, the US SEC, the Security Exchange Commission 2024 rules, cover only Scope 1 and 2 emissions, excluding Scope 3, with it, which FATIC 2024 and the SEC 2024 point out is often the largest part of the bank's carbon footprint. Now, global alignment is being shaped by ISSB and IFRS Scope 1 and 2, which sets a universal baseline for climate reporting. While the UK's SDR and the FCA anti-greenwashing rules raise the bar, Lloyd's should go beyond these by adopting the SFDR disclosure, reporting Scopes 3 via the PCAF, and obtaining third-party assurance. Moving on to slide 13. Now, short-term recommendations for the ban. Based on our findings, we propose 7 short-term actions to strengthen ESG credibility. Firstly, commission third-party ESG audit within 12 months to validate claims as recommended by the European Commission in 2023. Secondly, introduce a triple bottom line scorecard in the next reporting cycle. Thirdly, disclose Scope 1 and 2, Scope 1, 2, and 3 emissions using the PCAF standards within 12 months following the GHG in 2022. Now, the fourth recommendation align with the SFDR and the IFRS Scopes 2 within 12 to 18 months to reduce litigation risk. Fifthly, launch a public ESG verification tool within 9 months, and also establish an ESG claim committee within 3 months. Finally, embed sustainability KPIs in executive reviews by the next remuneration cycle. These measures signal strategic foresight and ethics intent, building trust with regulators and stakeholders. Moving on to slide 14, the long-term recommendations for the bank. Now, again, based on findings, for long-term success, Lloyds Bank must integrate sustainability across operations. Firstly, develop a net zero transmission plan by 2050 with 2030 interim targets, aligning with the Paris Agreement as stated by the European Commission. Secondly, implement real-time ESG reporting that includes Scope 3 emissions to meet the TCFD guidelines, as CIS, Cardoso, and Tatehaven in 2025 highlighted. Thirdly, for green financing partnership with NGOs, government, and renewable firms used by Albanese 2024. Fourthly, link employee incentives to climate goals. So following the model presented by HSBC in 2023, these steps will position Lloyds as a leader in sustainable finance while supporting global climate objectives. Now, moving to slide 15, the ethical arguments and policy justifications. Our recommendations must rest on a clear ethical foundation. Lloyds markets itself as sustainable, yet continue to finance fossil fuels, creating what Galetta in 2024 calls a false narrative that misleads investors. Greenwashing does more than harm the reputation. It diverts focus from real climate actions, as illustrated on the gov.uk side in 2021, admits that the UK regulations lack enforcement strength, while the European Commission in 2023 and the SEC in 2024 highlights how global standards offer greater accountability. Okay. We recommend mandatory third-party verification of all green claims to restore credibility and align with global best practice. This will strengthen trust with investors and regulators while positioning Lloyds as a true sustainability leader. Now, moving on to conclusion. Now, in conclusion, Lloyds Bank current sustainability narrative is misaligned with its actions. As Galetta observed in 2024, investing heavily in fossil fuel operations undermines both trust and the credibility of sustainable finance. Yes. The UK's weak enforcement described by Gov UK 2021 allows such gaps, whilst the SFDR and the SEC frameworks enforce clearer standardized reporting, as noted by the European Commission in 2023 and the SEC in 2024. Lloyds must adapt third-party verification, enhance ESG reporting, and align with global standards to restore trust and lead in sustainable finance. Thank you very much for the presentation.
Thank you, everyone.
Thank you.
Bye-bye.